with a tiny 4.67% short interest and a gain of around 136.92% since the last 1 year. Wing stock is, or rather, the Wingstop Inc. is operating in an industry that is intensively competitive, distinguished by minimal barriers to entry, non-existent switching costs, and consumer preferences for variety. Yeah, so the stock, yes, like I mentioned, has gained around 136% since the last 1 year. But over the last 6 months, it's around 6% it has gained. The stock has given up much of the gains it ran up. We saw it getting a rejection at around $425 as of July, second half of July this year, 2024, and has since pulled back to all the way down to where it is right now. Closed the last trading session at 386.11. But we have the probability that it will retest the probability that it can retest those highs, rather challenge that rejection of around 425% at 3.1%. So the probability that we will surpass that projection of that resistance of 425.24% is a tiny 3.1%. The probability that it will not surpass it is 96.898%. Yeah, but within that 3%, a lot can happen. The folks at Morningstar, whose report we're going to read out now, are indicating that the stock is overvalued. They have a fair value estimate of 139%. So one of their colleagues, what's his name again? His name is Simon Dunlop. He wrote that they believe that the firm's key uncertainties are tied to competitive risks, sensitivity to macroeconomic factors, like consumer health and inflation, and business execution risk. Wingstop competes with other chain and independent restaurants for financing, lease terms, restaurant sites, qualified workers, and franchisees. On the sales side of the ledger, Wingstop competes with other restaurants, grocery, and convenience stores for a slice of consumer food category spending, which is naturally constrained by size. Consumer preferences can change quickly, and operators must constantly innovate to remain relevant. Considering macroeconomic risks, Wingstop remains moderately sensitive to consumer health, with consumers displaying a tendency to direct trade towards cheaper channels during periods of stress. Input cost inflation remains the biggest concern for most operators after sharp increases in commodity and hourly labor costs during 2021 and 2022. Wingstop's food basket is particularly volatile, with chicken comprising 60% of the firm's cost of sales. Bone-in chicken wings represents the company's largest single exposure, constituting 23.1% of total costs, 23.1% of total cost of goods sold in 2021, and 34.5% in 2022, a dizzying 12% swing. But according to a recent report by CNBC, they have now switched from bone-in chicken to chicken breasts. So much of Wingstop's valuation is tied to its compelling development narrative, and their forecast, that is the forecast of the folks at Morningstar, and principally Sean Dunlop, the author of this piece we are reading. The compelling development narrative, you know, and their forecasts, and his forecasts, forecast cash flows hangs heavily on its ability to appropriately source strong finance partners, turning a robust development pipeline into open stores with competitive economics. Concentration risks adds to a degree of uncertainty, with more than half of the firm's stores sitting in just 3 US states. So the bulls are saying that Wingstop's early success in the UK could augur well for a further thrust in large continental European markets. with the ability to utilize more parts of the chicken across its menu, thighs, breasts. Wingstop should be able to stabilize food input costs for its franchisees and company-owned restaurants. A national marketing fee increase could help Wingstop narrow the brand recognition gap with its large international peers, driving stronger traffic to its US stores. And the beer case is that flagging traffic in the restaurant industry has yet to catch Wingstop. Flagging traffic in the restaurant industry has yet to catch Wingstop, but could pose an increase in headwind in the second half of this year, 2024, which is where we are right now, and into 2025. A lofty bone-in wing costs begin to as lofty bone-in wing costs begin to have an impact on restaurant profitability. The firm may be forced to raise prices in 2025 after a year-long hiatus. A concentrated menu could also reduce Wingstop's ability to reposition its prices should consumers' preferences shift. So, yeah, this is our piece on Wingstop. You know, see what you make of it, and I'll continue to update you. Thank you very much for watching this video.